it's very safe to say that in this space, because that also serves a lot of plastic and is quite a green thing to buy. But I've been very happy with it.
I must agree, a good soda stream there for sparkling water is always a great investment. So thank you so much to our panelists and for everyone in the audience. As you can see, we're really blessed to have a very hard-hitting group, everyone from academia through to direct investors, national treasury, and some of the biggest foundations in the space. So really blessed and really looking forward to hearing what everyone has to say. So in terms of just getting us kicked off, the idea for today in this panel is really to start the conversation around what are the opportunities from a climate finance perspective to innovative finance perspective to drive the growth and the rollout of innovative service delivery mechanisms within informal settlements, specifically focused on energy, but I think the conversation can be a little bit wider. But this idea of finance and the availability of finance is an ongoing question. So I think this is a really important one just to get the day kicked off. I'm looking forward to a couple of different topics coming up, everything from innovative financing models that exist both here and internationally, innovative business models that we've seen around the continent for implementing basic service delivery on the scale, a co-ownership with local community members, adaptions and procurement mechanisms, rethinking how we see free basic electricity, and maybe, most importantly, the idea of capital raising and what is available to local municipalities and utilities in the space. So I think on that note, let's jump right in. I'm going to ask the panelists just to start with an opening statement from their perspective as to this topic of financing innovative energy projects for basic service delivery. I'm going to start going the other way around, so I'm going to start with Tina in this case. Tina, if you wouldn't mind just opening up the panel for us.
Yeah, sure. Thanks, Jack. I think we've seen quite a lot of innovation in the access to energy space across the continent. Of course, primarily driven by Payasyougo models and companies like Mkopa and Solar Electric, previously Off-Grid Electric, and a lot of others, which we're probably all relatively comfortable with these. I think the interesting thing that has happened also recently and over the last couple of years is the ecosystems that have developed around them and the support that, for instance, the financing sector is increasingly given. I think one example of that also in South Africa is we've seen an Energize Africa raising 1.3 million to deliver renewable energy impact in South Africa, also through P4G, which is also individual investors actually contributing now to multiple different smaller companies in South Africa delivering energy and solar panels. But of course, one of the key bottlenecks, or one of the two key bottlenecks that keep coming up is risk and affordability. And we've also seen some interesting innovations actually solving for that. In South Africa, we've got the Green Outcomes Fund, which is, of course, a partnership between GreenCape and also the Bertha Center and WWF in South Africa. But that essentially incentivizes local investment funds to invest in green SMMEs and also, therefore, SMMEs that deliver basic services. It's the first of its kind, and it's a relatively big intervention of 488 million rand put through 4 different investment funds. So it's a fund-of-fund structure, which aims at building capacity in the local ecosystem and really building business models and a track record for investing early stage in these types of companies. A slightly different twist on that, which is a little bit easier to set up, a little bit more dynamic, is one of the ones that we've seen mainly in East Africa and also in Latin America, is a concept called social impact incentives, which is it's gaining traction by setting up an energy outcomes fund as well, focused on social impact incentives, SINC, which basically means that if you've got a solar company that's currently not attractive to investors due to its financial offering, then you can bring in a SINC partner, which pays for the impact created, which could be verified energy installations in underserved areas. That tops up the financials, and the company now becomes more attractive to other investors. The kind of front runner for that called Roots of Impact, based out of Germany. And as I mentioned, it's being rolled out in East Africa and in Latin America. And I think it's an iteration on results-based financing 2.0. And why that's important is because we've spent some time, and in my previous role at the Bertha Center, we spent quite a lot of time looking into the financing of the off-grid energy market. And what we kept finding was that there is a lack of coordination in the space. There's also a slightly dampened excitement around the prospects of the off-grid energy sector, just because it really is hard. And that means that very often then kind of the industry increasingly is circling around the better clients, the one who's better able to pay, the more peri-urban, the more urban, and therefore not necessarily the underserved markets. And in order to get there, we really need to bring in more catalytic capital and more blended finance really being public and private playing together, and that takes a bit of coordination, which is of course also why we continue to be quite impressed with the work that you guys are doing at GreenCape to really identify the right project from the beginning and bring in the right partners around that, and then take it from there. So let me pause there.
Thank you so much, Tina. I think you've raised some really interesting points there. I think particularly around that sort of risk and affordability concept. And I really like this idea of sinks. I'm keen for us later in the conversation to come back to the idea of sinks and their possibility in the space, but then also maybe bringing in the concept of renewable energy certificates and their role in this sort of off-grid electrification space. So maybe over to Avra for your opening statement to build on that.
Thanks, Jack. In my opinion, these are the most exciting and opportune times for municipalities from an energy perspective. It can be also one of the most challenging times. We have international changes, famously called the 4Ds, the decentralization, decarbonization, deregulation, and digitization, which municipalities are impacted by. These impact on a national level and a municipal level. In this changing energy landscape, municipalities can position themselves to take advantage of these opportunities and try to navigate some of the challenges. They can ready themselves and contribute to green economic recovery, whilst also aiming to provide the necessary quality services to their customers. But municipalities can't really do this alone. There are many players which contribute and assist and support, and it is in this interplay which opens the way for various initiatives aimed at facilitating innovative municipal service delivery from an energy perspective. And National Treasury recognizes that there may be some challenges from, in particular, legal and procurement point of view. There are many reviews, as you may know, which are taking place, such as a review of the PPP regulations, and that regulatory review proposes certain exemptions and thresholds to facilitate procurement. There is also the draft procurement bill, which was issued last year, and comments were received. National Treasury Procurement Office is working through those in order to streamline procurement and to replace some of the other pieces of legislation like the PPPFA. And the aim is to really facilitate procurement. There are a number of projects ongoing at National Treasury and wider government at the moment, all aimed at supporting municipalities. Importantly, this reform of sustainable municipal energy businesses is backed by Operation Vulindlela, emphasizing the presidential action to support private sector participation in municipal procurement of new generation capacity and really facilitating service delivery. But I'll leave it at that. Thanks.
Awesome. Thank you so much. I think, yeah, some really important points there around the concept of partnership. And I'd love to, again, come back to what you mentioned around the adaptation and review that's happening with the PPP and also the procurement legislation as well. I think that's a really important and a big challenge in this space. Mohammed, over to you to continue the conversation.
Thank you so much. So I think our approach in terms of identifying innovative finance mechanisms is to identify what are the challenges, let's say in this particular context, municipalities are facing in terms of unlocking, projects, in the energy sector. And that's been our approach in terms of designing specific funding mechanisms. And so some of the challenges we face, for example, as a DFI trying to support infrastructure in the sector is, for example, especially in light of the impact of COVID on our cost of funding, which has increased significantly, especially with the, with downgrading by rating agencies, is, how do we remain competitive and also offer products which are useful for municipalities. So blended finance has been quite key in that regard. So being able to access concessional finance from, the likes of, UNFCCC finance mechanisms, and blending that with funding from the DBSA, has been quite important. But coupled with that, identifying de-risking mechanisms to also crowd in private sector to support, renewable energy projects. So in that regard, we're currently looking at a program around embedded generation, for example, focusing on both private and public sector projects, where municipalities could be off-takers or they could be producers, obviously in line with the current legislation. So the idea behind those programs, once again, is to identify what are the challenges that municipalities are, for example, facing, as well as private sector, in terms of procurement, and in terms of undertaking renewable energy projects. And we've been trying to look at alternative mechanisms to procure renewable energy outside, for example, the REAP initiative. So we've developed credit enhancement type of facilities where we offer subordinated debt, first loss facility, etc., as a means to once again de-risk these projects in the absence of sovereign guarantees. So the REAP program is very much dependent on sovereign guarantees. So how do you identify alternative finance mechanisms where you're not very much reliant on those guarantees, but you are still able to entice private sector to come on board and support these embedded generation projects. So that's a program which we just recently kind of got an approval for, and we kind of open for business in terms of trying to identify projects in that regard. So it would be interesting just to see whether our thinking around such initiatives has been correctly kind of thought through. And hopefully we hope to see interest from municipalities to participate and accessing those type of facilities. On the off-grid side, and supporting informal settlements, we've not done much, to be honest, in terms of our mainstream funding. We have supported pilot initiatives through the Green Fund, which is a national fund that the DBSA used to manage on behalf of the Department of Environmental Affairs. So we have supported, for example, the iShack project in Stellenbosch, where they've been rolling out solar home systems. And I'll talk a bit about that maybe a bit later, but they've explored different models, and the model has evolved as we tested that particular pilot in terms of looking at a pay-as-you-go model, but it's still very much dependent on the free basic electricity or subsidies from municipalities. But maybe I can touch upon that a bit later. But I think the bottom line is, for us, innovation is around identifying what are the key challenges and how do you identify the right instruments to address those challenges. So it could be, it will vary from project to project. So we're also exploring, for example, guarantees that we, to support energy efficiency, for example, where those guarantees or credit risk guarantees can be used to again encourage commercial banks to provide loans to SMMEs that are involved in providing energy efficiency intervention. So that's a model we're looking at, around a energy efficiency program, once again together with our partner, the Green Climate Fund. Thank you, Jack.
Great, Marvin. Thank you for that. I think there's definitely a number of lessons that can be drawn from the successes and failures on a sort of REAP level with innovative financing. And great to hear you bringing up the concept again of mechanisms, innovations to try and de-risk, financing for this space, and also interested to hear a little bit more around that sort of access to concessional debt or concessional finance for South African interventions. A lot of the big funding mechanisms specifically focused around off-grid electrification have not focused on South Africa, so we'll be interested to hear a little bit later around your thinking on that. Over to you, Dr. Ledger, to take us with your opening intro.
Thanks, Jack. So I think we're approaching the issue from a different point of view, and that's around the linkages with household poverty and access to affordable electricity. I think we're all aware of the linkages between access to affordable electricity and poverty, inequality, livelihood opportunities, and a whole host of benefits. The main problem in the current system is that such access is not a priority for local government. And that's really not much of a choice that they have. So the local government fiscal framework has been built on the assumption that local government can finance almost 40% of its total operating expenditure from the surpluses earned on electricity sales. So it's not that, municipalities are selling at a higher rate to wealthier households to subsidize the cost to poorer households. There's also a big chunk of money that municipalities have to earn from electricity in order to cover all of their other operating expenditures. So what has happened is that electricity has essentially become the balancing item on a municipal budget. And it's quite clear that there's a very high level of financial distress across municipalities, especially smaller municipalities. So there's enormous pressure for them to increase their services charges to plug that gap. So, the price that municipalities can charge for electricity isn't just determined by NERSA. The MFMA gives them the opportunity to levy all sorts of other charges. And what we've seen over the last 10 years is that the cost of electricity for the end user has risen 3 times more than the cost of inflation. So there's absolutely no guarantee, there's no built-in system that will guarantee that just because municipalities can generate their own power or buy it from independent power producers, that benefit would be passed along to end users. In fact, it's much more likely that it would be used to just plug the holes in the local government balance sheet. What we see already is that with free basic electricity, just over 10 million households are funded in the national budget for free basic electricity, but only about 2 million households get it. And even if we bear in mind that 2.5 million households don't have access or are not connected to the grid, that still leaves 5.5 million households that should get the free basic electricity, but they don't, because it's a non-conditional grant. If the municipalities don't provide the free basic electricity, they can divert it to revenue. So for us, the real priority is how do we turn all of these things into meaningful benefits that will address poverty and address inequality. And then, of course, the other issue with all sorts of funding of new infrastructure and new investment is the transparency and accountability around that. We've seen the debacle with the World Bank loan to Eskom, gross mismanagement of the funds, with the idea that the lender carries no responsibility for that because the user will simply bail the borrower out. So how do we make sure that we don't build ourselves a new system where we've got all sorts of obligations to new suppliers in the system? There's no transparency on the actual cost of the debt because of this idea that we can keep simply passing the cost through onto the end users. So for us, the main concern would be how do we, into this whole system, how do we build a much better guarantee of affordable access to energy for all South Africans than we've seen to date? Thanks.
Great, thank you so much. I think it's a really fascinating conversation where a lot of questions and a lot of interest in the sort of just transition narrative from a supply side. And I think you're touching on a really interesting aspect there of how does the just transition translate on a distribution side and that guarantee or that ability to provide access. So I think that's a great additional lens to bring into this conversation. So I think let's get started with some of the questions. And just as a reminder to the audience, if you do have questions, please pop them up on your chat box on the platform, and we'll ask some of the panelists those questions towards the end. But maybe I'm quite keen to start us back right in the beginning, and I'm going to ask Tina to take this first question. Quite simply, what is innovative finance, and why is it relevant for this challenge? Why can't we just go to traditional banks, just get debts or some sort of normal market-related equity type investments?
Thanks, Jack. That's a good question. So let me start with your first one, right? Like, what is innovative finance, and why do we kind of need it in this conversation? So if we start at the beginning, innovative finance is really just shaking up a traditional toolbox of financing, right? In order to find the right way of working on these important issues, these development issues, also of basic service delivery. So for impact businesses, there's often been just a few different ways of getting to markets. And for traditional financiers, there's the building blocks of finance, which is traditionally equity, debt, and grants, right? Innovative finance, or impact investing, if you will, is focused on tweaking these tools to identify ways of doing business slightly differently, but also to identify how do we really blend public and private funds in order to make more efficient partnerships, and also to make the resource pool bigger for basic service delivery. And that's really important also in light of what we've just heard, right? In terms of passing on the cost, the affordability, the risk, etc. We need to think of things a little bit differently. So why is it relevant for this? I mean, I've heard quite inspiring senior members also of the DBSA talking about the fact that we need to do things differently. We need to think about risk differently in financial institutions. It's not just financial risk, but risk is also being able to, or not being able to, provide basic service delivery for a significant number of South African rights. And that's a realization that we increasingly need for big pools of capital, for institutional investors, for government, etc., insofar as we can then bring players around the table to really start thinking about creative solutions. And you asked, well, why can't we just do this through traditional means? And that, to some extent, is because there is a lot of innovation that needs to happen that, to some extent, is costly. There is it's a lot of risk that we need to think about. Where does it really sit? We need to think about who is it really creating value for as well. So in order to say, well, how do we actually, exactly as in the Sync model, how do we potentially increase the kind of attractiveness of these different investments, and how do we think differently about the capital that is provided that goes early stage and takes on a little bit more risk, and how do we then tweak it, right? So I think some of the innovations that we've seen in this space, also in terms of innovative business models, is really around, well, first of all, the financing, which we can talk a lot more about, but also just in terms of the business models. How do you make different organizations also work differently together? We've seen across the continent players teaming up, for instance, TV content providers teaming up with solar panel and off-grid companies to then share the revenues, where the TV content providers share the revenue with the off-grid solar provider, because the off-grid solar provider needs a bit of a top-up, right? So there's different kind of creative ways of getting to this. Or it can be saying, let's start differently in terms of how do we think about putting up microgrids and solar companies, not necessarily massive projects one at the same time, but how do we start a little bit smaller? How do we build it incrementally? How do we make the community also active owners in these projects, and how do we then structure the financing around that? And that's very much what innovative finance and impact investing has been spending quite a bit of time thinking about.
Thank you so much. I think that gives us a really nice sort of foundation for the rest of this conversation. I want to sort of zoom in on one term you used quite early on, is that ability to create a bigger resource pool. And I'm quite interested from Mohammed, from DBSA's perspective. Obviously, raising capital remains quite a big challenge, both from a sort of SME that's actually implementing perspective and from a municipality's perspective. But I'm quite interested to hear from a funder's perspective, what are some of the biggest challenges and opportunities to partnering with a local municipality to roll out something like innovative service delivery?
Thank you, Jack. I think from our experience, and I'm talking specifically in the context of, let's say, some of the facilities we've set up, in recent years, especially around, supporting renewable energy projects and energy efficiency projects. So I think it's all good and well to have, facilities, that municipalities and private developers can access. The challenge we've certainly seen in especially in recent months is that a lot of municipalities, especially your under-resourced municipalities, do not have the capacity to develop bankable projects. And we've seen this, for example, with the embedded generation program, where there's a lot of interest to access the program, but the criteria to access that facilities, you need to have a bankable business case. So there's a strong need for project preparation support, to position those projects to bankability, and ultimately to a point where they can start accessing these funds. But even prior to that, just doing pre-feasibility studies, is a challenge for a lot of these municipalities. So what we've done, for example, recently is we've partnered, with ICLEI, and also tried to access some support from UK Pact, specifically to support municipalities. And unfortunately, we can't, support all municipalities, but certainly it's a starting point in terms of setting up some sort of, let's call it project preparation facility specifically for embedded generation projects, where we can support some of these smaller municipalities to undertake pre-feasibility studies around embedded generation, for example. And ultimately, the outcome of that exercise, those projects would then feed into the DBSA's, for example, project preparation fund, which we have a dedicated fund where we would then do actual preparation work to take it to bankability. And after the project preparation phase, you then go into accessing these programs and facilities. So I think funding is just part of the challenge, and it's just being able to access these funds, which is quite key. So we hope that by filling the gap in this funding value chain, we're able to solve this challenge of especially your smaller municipalities who may not be positioned to develop projects where they can access these these programs which we've made available, where we can provide concessional finance and other types of de-risking instruments, whether it's credit enhancement, etc. So I think that's something that we've certainly come across, where project preparation and the ability to develop bankable projects is a major challenge for a lot of municipalities.
So I want to come back to you sort of brought up partnership again there, so I'm keen to come back to that in a second, but I'm interested to understand, how can a municipality sort of access this? What is the approach to trying to get to be on part of this process for the work that you're doing?
Right. So look, obviously the facility that we just recently got an approval for through UK Pact, because it's a small facility for now, we've already identified a couple of municipalities that would form part of this pilot. So at the moment, because it's limited funds, we're not in a position to, let's say, open it up to everybody at this stage. But I think once it's a 12-month period that we have this partnership with ICLEI on this particular initiative. Hopefully after the 12 months, and we've demonstrated that the pilot, the municipalities that we would be working with, at least for this pilot phase, there would be appetite to perhaps scale up this particular project preparation facility and maybe support a much larger number of municipalities. Initially, our plan was to support 11 municipalities. Unfortunately, the funding that was available, we could only support, I think, up to 4 for now. But hopefully we would reach a point where we'll be able to expand this facility, maybe even with DBSA funding as well, to support a greater number of municipalities. So I think for now, unfortunately, we're limited, to those 4 that we've already identified through our municipal team within DBSA. I can't remember the names of those municipalities, but I think as we implement this pilot, we may be in a position to share more information around, what's possible in terms of supporting other municipalities in the space. But by all means, in terms of municipalities that already have done pre-feasibility studies, they can access DBSA's, for example, project preparation fund, which is open. There is a website. We've just updated our website, and they can certainly see the criteria to access, the project preparation fund, where you need at least to have a feasibility or pre-feasibility done. In some cases, we will need some feasibility work that would have been done already, and but you're not ready in terms of having a bankable business case. So there, that fund is available, and I'm happy to share some information, perhaps through this platform, in terms of details around how you can access the project preparation facility from the DBSA. With regards to the embedded generation,
I'm gonna jump in there, Mohammed, because I'm keen to come back to the partnership question before we get a little deeper there. But I think that the networking session there offers a good opportunity to share some more of that later on if you are interested from the DBSA's perspective. So apologies for cutting you off there. I'm quite interested, Avra, from your side. Earlier you mentioned the concept of sort of re-looking at the sort of procurement policies, and this may be a swear word, but re-looking at the triple P sort of policies and legislators as well. This idea of partnership is obviously quite important for the successful rollout of sort of innovative service delivery. So from a legal perspective or from a procurement perspective, what are some of the things that we're trying to adapt, and what are some of the things we're looking to change in these different sort of policy spaces?
Yeah, thanks, Jack. That is an interesting and topical question, which in my opinion must be considered from two dimensions. The national efforts and the municipal efforts to promote innovation in service delivery. From a national perspective, so we talk about, what are the changes? How do we adapt the legal and procurement framework? And there's 3 steps here, I think. The first is to fully understand the framework. We have amendments that have been made to the new regs, which is new, and we have existing legislation such as the Municipal Finance Management Act, the Municipal Systems Act, the Triple P regulations, and we must remember that we are dealing with procurement, which from a National Treasury point of view is general procurement related legislation, which now must be adapted to a specific situation of energy procurement by municipalities. And we're also dealing with 2 government departments which must work together in these processes. And when we talk about embedded generation, do we really now understand how these different pieces of legislation work together, how they align, what are the triggers for each of these provisions, where does the DMRE step in, where does National Treasury step in, when does NERSA step in, and really mapping out this legislative framework as the first step. But it's also not that simple. There are different procurement options and transaction options and mechanisms. So a municipality can decide to go the PPP route, and this will obviously trigger the PPP regulations. Or it can buy from an independent power producer through a power purchase agreement, which will trigger other regulations and legislation. Or they can build on their own through funding. So each of these will trigger different legislation and regulations. Now try to overlay that with different possible scenarios, such as the use of municipal land by an independent power producer, or a pool of municipalities buying from one IPP. This can be really complex or daunting, even for metros or other municipalities who may or may not have the capacity. That's why we're looking together with various departments in National Treasury and throughout government, together with the DMRE. We have a piece of work where we are analyzing right now and mapping out the legal and regulatory framework as it stands. This is funded by the World Bank, and we recognize this as a need to provide guidance to municipalities to better understand the procurement process, but also to indicate what this procurement process is for private sector and be able to give them some sort of assurance and certainty, which then mitigates some of the risks and the challenges that come with having an uncertain framework. And once we've done this, which we're in the process of doing, we need to then, as a second step, understand, does this really work? So when we map out the legal and regulatory process, including the Section 33 process and the PPP process, are there areas here that can be streamlined? So a gap analysis. can we assess where the hurdles are, what are the challenges, and see if there really is an opportunity to streamline this process. And that's where, you know, some sort of a recommendation for, let's call it adaptation or amendments. At the end of this, there will be an MFMA circular with flowcharts and roadmaps and timeframes, mapping out each of these different scenarios. And this is where we're trying to work within the legislative framework, but also looking for better innovative ways to understand and streamline the process for procurement of energy by specifically municipalities. I've mentioned that this exercise will then contribute to what we hope is a conducive, enabling environment for investment and certainty, and provide some sort of certainty for private sector participation. But as a third step also, we need to, as municipalities, I think, be able to learn and share knowledge, which I think there, and this is my opinion, there isn't a lot of that going on. So City Support Program is, we've set up a community of practice, and this will be convened in May, where we are giving municipalities and metros the opportunity to discuss and to contribute their case studies, how they've gone through procurement of electricity, what are some of the hurdles. And this is really to share knowledge and to capacitate one another, but also to lift out some of the hurdles and the challenges that we may not be seeing from a practical perspective. And this then is supposed to be an iterative process, we think, which can feed back into trying to streamline and adapt the procurement legislation and process. So this, Jack, is where we're really trying to facilitate that enabling environment, give some sort of certainty, capacitate municipalities, and also try to prepare them not just for now, but to transition towards hopefully resilience and sustainability in this changing energy environment. We are also aware, and I think Mohammed mentioned other factors which contribute to uncertainty and procurement challenges. We've been approached by some of the metros and municipalities. We work closely with SALGA, and there's been a call for assistance to develop a standard bankable PPA. And this is really a challenge that metros, municipalities at large have. I think there was a mention of a lack of capacity, but also a lack of finances. I mean, to put together a bankable PPA is quite expensive, and if all municipalities embark on that, it can be quite expensive. So we're looking together we're in discussions for funding to put together a standard PPA to cater for some of these different scenarios that come out of the work that we're currently doing. And yeah, so that's some of the work from an innovative perspective. I know that Mohammed spoke about credit enhancements as well. I think as National Treasury, it's dear to our hearts that we look at other mechanisms other than government guarantees. I don't want to talk much about whether there can be a government guarantee for municipalities or not. What I can say is that we are working with the European Climate Foundation on policy briefs to identify alternate credit enhancements and certain mechanisms for municipal energy projects. So there's a lot of work that's being done in this space, and I think municipalities really need to take advantage of the initiatives and the opportunities that are there. We are also looking at carbon credits and the application of the MFMA on the sale of carbon credits by municipalities. And we're hoping that all of these initiatives are conducive to an enabling environment which facilitates procurement and which leads to an increased service delivery. So I have mentioned from the national perspective, and I have touched on from a municipal perspective, and I think it was Tracy who mentioned that municipalities also need to recognize, which I think they do in part, the changing energy landscape and the full ramifications and impact this will have on their revenue and their business model, which is changing. So there's a potential.
I'm going to jump in next. I'm keen for Tracy to chat about that in 1 second. But I wanted to ask you, you've highlighted a lot of these different work that you guys are doing, and I think it's really amazing work. Quite keen to understand timing of that first paper that you were mentioning, just around sort of mapping out all the different regulations and how they've changed. And then perhaps we can think about in a longer term, like an online one-stop shop where municipalities can get access to all of this information. But yeah, just one last question there on that timing for that original piece of information that you mentioned earlier.
Yeah, thanks, Jack. And I think timing is important. We recognize that it's quite critical. It's important. Municipalities are embarking already on procurement of new generation capacity. So our consultants are already have already started. The timing potentially is the end of May, middle of June for the circular to be issued this year, if all goes well, and we're anticipating that it will. So yes, a lot of engagement taking place. It's not just National Treasury. I must emphasize that a reference group has been set up because there are different, and it's new to everyone. It's new to the DMRE as well. We must recognize that this is something that they've put in place, and we need to work together with them to map out this full value chain. So to answer your question, you're looking at end of May, middle of June, and I like your idea of the database. So thanks for that.
Brilliant. Thank you so much for sharing all of that information. I think everyone mentioned there the sort of idea of municipalities starting this transition towards a sort of a resilience space. Tracy, in your opening conversation, you spoke about the sort of just transition and the impact that's going to have on the sort of distribution landscape. So I'm quite keen to hear your thinking on, what does this just transition mean for the end user in this sort of service delivery type space? And what are some of the things we should be looking out for, both from a challenge or an opportunities perspective?
Thanks, Jack. I think the important thing to remember is that if we don't start thinking more clearly and in more detail about the mechanics of the distribution parts of the system, what you would kind of call just distribution or just access, we run the very real risk of entrenching two parallel energy systems. One kind of visible system that looks green and just and decarbonized, while on the other hand, sort of permanently forcing millions of households to use coal, paraffin, firewood, animal dung, and other things. So we really run the risk of entrenching inequality and having what we think is a decarbonized energy system and a just energy system, whereas the reality for millions of households is completely different. So, policy making is always about trade-offs. It's always about choosing one thing over another or deciding to do something and partially not do something else. The problem we have at the moment is that there is an effective trade-off here between the financial viability of local municipalities and equitable access to energy for poor households. The problem is that trade-off is largely invisible. It's largely invisible to policymakers. It's largely invisible to many households themselves. So it's not just about saying, how do we adjust tariffs or adjust things? But we need to understand that every decision we make about tariffs and access that might benefit households on the one hand might undermine municipalities on the other hand. And we need to understand that a lot of the operating costs that we're subsidizing with electricity is, for example, maintenance of the water system, it's maintenance of the roads, it's maintenance of basic infrastructure. So I think the most important challenge is firstly to acknowledge that the 1998 Energy White Paper had as its number one priority affordable access to energy for all households, small businesses, and small farmers. And we need to move to progress that right, because we've actually made very, very little progress towards that right in more than 20 years. We've got this half-baked, inadequate free basic electricity policy, which is so badly implemented, frankly, it might as well not even exist. So we need to acknowledge that priority and the reasons for that priority, that access to energy is fundamental to socioeconomic transformation. And we need to take concrete steps to realize that right. But at the same time, we need to understand that involves a trade-off in terms of the local government fiscal framework, and we need to work to address both of those issues at the same time. So we need to make that trade-off visible, and we need to be much more innovative and clever about how we address the situation.
Thank you so much. I think that's a fascinating sort of lens to bring to this conversation. And Parry, through Dr. Ledger, have just released a very interesting working paper that's well worth the read, that goes into a little bit more detail around this specific topic. So we're going to take a couple of the audience questions now. I think a lot of interesting sort of work has been tracked through here. So just going to jump to a couple of the questions. First, maybe to Tina. There's been quite a lot of mention around the fact that, you know, municipalities are not necessarily going to be able to do this themselves. It's going to take sort of partnership and participation from, you know, investors from a number of different lenses, and ultimately the private sector in actually implementing. I'm keen, from your experience, both at the Bertha Center and the Bestseller Foundation, what are some of the models that have been implemented in terms of sort of innovative business models around the rest of Africa that have worked to deliver sort of basic energy services from this lens of partnership?
Yeah, thanks, Jack. And I think, I mean, that can probably be done relatively fast, right? So I think that is largely driven by what we've seen in the pay-as-you-go innovation, which drove a whole new market, both from obviously mostly successful in East Africa, and then to some extent also in West Africa. And I think over the last 9 years-ish, we've seen kind of a whole sector develop around pay-as-you-go models, off-grids, remote access to energy, right? And also then lastly, a lot of hype and a lot of excitement around the fact that, oh, here is a business model that actually could ensure that investors got their money back, that we got off-grid energy, that communities had access to energy. And then, as I think I mentioned at the beginning, now a little bit further down that road, exactly as Tracy was saying, we're seeing that it's not necessarily going the last mile, it's not necessarily going to the underserved, because that it is really difficult to get the affordability and the attractiveness of the business model right in terms of in terms of mixing both those elements, right, like the profitability and the underserved. And it's not to say that it's not possible, but I think it really is to say that we need to think more creatively, and we need to be more okay with the fact that it's not going to be only on, I'm not going to say market terms, you know, kind of still concessionary impact investing terms where you get your money back, you get it back with like a return, but we will have to accept that there is a blended element to this that means that it needs concessionary catalytic capital, and it needs more kind of impact investing, more private sector capital as well. I think that's been one of the big lessons from what we've seen. And that to some extent is also why we are still quite excited about the Green Outcomes Fund, of course, providing catalytic capital also from National Treasury and from local foundations, and mixing that up with local investment funds that then can provide access to capital at an earlier stage, taking on a little bit more risk, and also really blending the impact and the cost of capital, right? So not only is your access to capital driven by the fact that you are going to create impact, but also what we can see is that then we can kind of link it on an ongoing basis. So if you shoot the lights out in terms of your targets, then the cost of capital, your interest rate, et cetera, can also go down over time, right? So I think we need to be a lot more specific around how we build in that intentionality, also learning from a lot of Tracy's and Avra's work into these finance models to say, okay, great, there's intentionality, there's measurability, and we've got the right kind of blended capital mix. And we can learn a lot actually from the lessons that have been learned, not necessarily the hard way, but just by nature of time and you know, implementation that has happened on the rest of the continent that we can now take into South Africa, because we have been a little bit, we haven't moved as fast on some of these innovative business models as they have elsewhere.
Thanks, Tina. I think one of the important sort of aspects of all of those different models that you've mentioned is this sort of idea of co-ownership with local communities, sort of co-payments. And I think that links nicely with potentially Tracy's points around rethinking what we're doing with FBE. So can FBE be used as a mechanism to help co-fund or support low-income users to fund solar home systems, for example? I think that's the question that still needs to be answered as to, is that FBE, is that FBAE, and how is that implemented by the municipality? I've got sort of one more, a bit of an open question here. So anyone that's keen to jump in is welcome to. Another is the question from the floor. And it's really trying to find out, what is the long run role of the municipality from your perspective in the sort of electricity landscape? So what is the long run role of the municipality within the electricity landscape, maybe particularly from a service delivery type lens? Anybody keen to jump in on that one?
I don't know, Jack, maybe it's kind of related to that question, but also leading on to what Tina just mentioned. I just wanted to maybe just talk about a minute or so just on the the case study around rolling out of solar home systems in a South African context with the GEISD project. So I think there in that particular example, we've seen that solar home systems are an appropriate, obviously affordable technology for provision of basic electricity, services for informal settlements. However, the funding of the hardware for such services, must come from infrastructure investments or national government, whereas the operational and maintenance cost, can come from end user fees, bearing in mind that there are a lot of sensitivities and ethical issues around, withdrawing that service if there's non-payments. However, the role for municipalities in terms of the better or more effective use of the subsidies is to basically complement those fees and subsidize the cost, for the maintenance and operations of those solar home systems, just to ensure there is operational sustainability. So I think that's kind of currently the model, where we believe, at least with the GEISD project, there could be opportunities for replicability. However, the provision of that service, to unlock, obviously it has the potential to unlock a whole lot of other benefits in terms of using, agents or community members to be agents for that particular service. But the other issue, or the other point to remember with that particular, with such type of services, is that it has to be run on a almost as a non-profit type of kind of motive. So the GEISD is kind of run as a social enterprise rather than a profit-making entity, although it has to obviously ensure that the operations can be sustained. So I think that's just I just wanted to mention the experience we've had, in the South African context around the rollout of solar home systems in the informal settlement context, and some of the key lessons we've learned in that regard. So I think there was a key role for municipalities in that particular context in terms of ensuring that expectations are obviously set, because there is an expectation that everything should be for free. But we felt that there had to be some end user fees at least to cover the operational and maintenance costs. Thanks, Jeff.
Brilliant, Jeff. Thank you so much for that. And I know we could keep chatting for a long time. There's some great questions.
Can I jump in there quickly?
Cool. One minute.
I think it's important to remember that Eskom supplies electricity directly to more than 50% of South African households, and probably supplies electricity directly to about 2/3 of the poorest households, thanks to the township electrification project. So we need to understand that in terms of providing access to low cost and affordable electricity, that Eskom is probably a much more important supplier than municipalities.
Thanks. Yeah, I think a really important lens we haven't yet brought into the role of Eskom in this wider partnership. So how do we create partnerships and synergies and best practices between what Eskom are implementing, what local municipalities are implementing? I think we could speak for ages on this, and there's still some great questions in in the chat box around innovative models that can be used to increase the affordability from a customer's perspective, to foster community ownership. So for those that are asking that, please do head back into the networking session a little bit later to ask the panelists. Hopefully we'll all be there, those questions. What I'm going to do is I'm going to thank the panelists for the time now. I wanted to give us a few more minutes for closing comments, but for now, I think we're going to end off the session. Really, thank you so much to each of you. I think we've covered some really interesting topics here, from the need from coordination to speaking about partnerships, speaking about the ability to de-risk and create the mechanisms to move companies and projects towards bankability. And I really like this idea of sort of monetizing and moving towards social impact incentives. And how do we promote these different mechanisms that exist out there and learn from best practice around the continent. I think still some of the unanswered questions for me that we're wanting to continue to explore is how do we start to access this larger pool of concessional finance to sort of really target that into South Africa. What is the ultimate role of FBE in the longer term run as we start to see this decentralization of energy? And then how do we start to move to really promote what Tracy mentioned in that 1998 white paper of universal access, and what does that start to mean in the future state? So from that, I want to thank the panelists very much and thank the audience for their questions, and I hope that you do stick around for the networking session later. Thank you all. Bye-bye.